Every successful business, every thriving organization, and every financially secure individual relies on a fundamental, indispensable practice: accounting. More than just crunching numbers, accounting is the very language of business, providing clarity, insight, and the critical information needed to make informed decisions. At its essence, accounting is the systematic process of recording, summarizing, analyzing, and interpreting financial transactions. It's how we track where money comes from, where it goes, and what financial position an entity is in at any given moment. Without it, the financial world would be a chaotic, indecipherable mess. Accounting's purpose is multifaceted, serving internal management, external stakeholders, and regulatory bodies alike. Firstly, it provides accountability. It shows how resources have been utilized and whether responsibilities have been met. Secondly, it facilitates decision-making. Managers use accounting data to plan, budget, and control operations. Investors use it to evaluate potential investments, and creditors use it to assess lending risk. Thirdly, it ensures compliance. Businesses must adhere to various financial regulations and tax laws, and accounting provides the necessary records. To cater to its diverse users, accounting broadly divides into two primary branches: financial accounting and managerial accounting. Financial accounting is all about providing financial information to external users, people outside the daily operations of the company. These include investors, creditors, government agencies, and the general public. Its main goal is to present a fair and accurate picture of an organization's financial health and performance over a specific period. The output of financial accounting primarily takes the form of financial statements. These standardized reports are meticulously prepared following a set of rules called Generally Accepted Accounting Principles, or GAAP, and International Financial Reporting Standards, or IFRS. These standards ensure consistency and comparability across different companies. The three primary financial statements are the income statement. This statement reports a company's financial performance over a period of time. It shows revenues earned, expenses incurred, and ultimately the net profit or loss. It's like a video showing how well a company performed financially during a given time frame. The balance sheet. This statement provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, assets, what it owes, liabilities, and the owner's stake in the company, equity. The fundamental accounting equation, assets equals liabilities plus equity, is always in balance on this statement. The cash flow statement. This statement reports the cash generated and used by a company over a period of time, categorized into operating, investing, and financing activities. It's crucial because net income doesn't always reflect actual cash movements. Financial accounting is essential for transparency and trust in the capital markets, allowing external parties to make informed decisions. In contrast to financial accounting, managerial accounting, also known as management accounting, focuses on providing financial information to internal users, the managers and employees within an organization. This information is tailored to help them make strategic and operational decisions to improve efficiency, profitability, and overall performance. Managerial accounting is less concerned with strict rules and more with relevance and timeliness. It's forward-looking, helping to plan for the future rather than just reporting on the past. Managerial accounting is a powerful toolkit for managers, enabling them to navigate complexities, optimize resource allocation, and steer the organization towards its strategic objectives. Regardless of the branch, several fundamental concepts and principles underpin all accounting practices. As mentioned with balance sheet, this is the bedrock of double-entry accounting. Assets equal liabilities plus equity. Every transaction impacts at least two parts of this equation, ensuring it always remains in balance. This foundational system, double-entry bookkeeping, requires that every financial transaction has an equal and opposite effect in at least two different accounts. This is recorded using debits and credits. This ensures accuracy and helps prevent errors. There are two methods for recording transactions: accrual basis accounting. records revenues when they are earned and expenses when they are incurred, regardless of when cash changes hands. This is the standard for most medium to large businesses. Cash basis accounting records revenues only when cash is received and expenses only when cash is paid out. A core principle of accrual accounting, the matching principle, dictates that expenses should be recognized in the same period as the revenues they help generate. This allows for a true measure of profitability. This principle, going concern principle, assumes that a business will continue to operate indefinitely. This allows assets to be valued at their original cost rather than their liquidation value. The world of accounting has been profoundly transformed by technology. Gone are the days of solely manual ledgers. Today, sophisticated accounting software, enterprise resource planning systems, cloud computing, artificial intelligence, AI, and data analytics are revolutionizing the profession. These tools automate repetitive tasks, enhance accuracy, provide real-time data, and enable accountants to focus more on analysis, interpretation, and strategic advisory roles. Accounting is merely not a compliance function, it's a strategic necessity. For businesses, it guides operational efficiency and acts as the scorecard for performance. For investors, it provides the data needed to assess a company's health and potential for growth. For creditors, it helps evaluate a company's ability to repay loans. For individuals, understanding basic accounting helps in personal financial management and budgeting. Accounting provides the transparency and reliability essential for trust in the global marketplace. It ensures that financial information is consistent, understandable, and actionable, enabling smarter decisions at every level of the economy. It is, without a doubt, the universal language of business.